Did you know that the average investor's portfolio underperforms the market by nearly 2% every year? This gap can cost thousands in missed returns over time. But what if you could bridge that gap and build a winning investment portfolio starting today? Welcome to today's video. We're diving deep into one of the most critical aspects of financial success, how to build a winning investment portfolio. Whether you're a seasoned investor or just getting started, creating a portfolio that grows steadily over time is the key to achieving long-term financial goals. In this video, you'll learn about the strategies that successful investors use to outperform the market and avoid common pitfalls. By the end, you'll have a clear roadmap to building a strong, diversified portfolio that aligns with your financial goals. So, what's stopping most people from building a winning portfolio? One of the most common mistakes investors make is chasing short-term gains or reacting to market fluctuations based on fear or hype. Instead of focusing on long-term growth, many investors overtrade, try to time the market, or invest heavily in individual stocks that carry too much risk. These mistakes can erode potential returns and make it difficult to achieve consistent growth over time. Another challenge is a lack of understanding about how to balance risk and reward. Without a proper understanding of asset allocation, many investors take on too much risk or they play it too safe, leaving potential returns on the table. Building a strong portfolio requires a well-thought-out strategy that combines risk management with long-term growth potential. But don't worry, we're about to show you how to overcome these challenges and build a portfolio that sets you up for success. Now, let's explore the key components of a winning investment portfolio. The foundation of any good portfolio starts with asset allocation. Asset allocation simply refers to how you divide your investments among different asset classes, such as stocks, bonds, and cash. A well-diversified portfolio ensures that you're not putting all your eggs in one basket, which helps manage risk and smooth out returns over time. For example, stocks tend to offer higher returns but come with higher volatility, while bonds offer more stability but with lower potential gains. The key is finding the right mix based on your risk tolerance and financial goals. Speaking of risk tolerance, this is another crucial element. Every investor has a different appetite for risk based on factors like age, income, and financial goals. Younger investors with a long time horizon may be more comfortable with a higher risk portfolio that's weighted towards stocks, whereas someone nearing retirement might prefer a more conservative mix that includes more bonds or dividend-paying stocks for income. Understanding your risk tolerance will help you create portfolio that feels right for you and keeps you invested during market downturns. Another essential concept is diversification. A diversified portfolio spreads investments across various sectors, industries, and even geographical regions. This reduces the impact of any single asset or market segment underperforming. For example, instead of investing all your money in tech stocks, you might diversify across healthcare, consumer goods, and energy stocks. You could even include international stocks for additional diversification. Diversification helps smooth out returns and reduces the overall risk in your portfolio. Here's the key strategy that can take your portfolio to the next level: rebalancing. Rebalancing involves periodically adjusting your portfolio to maintain your desired asset allocation. Over time, as certain assets perform better than others, your portfolio can become unbalanced. For example, if your stocks outperform your bonds, you might end up with a higher percentage of stocks than intended, exposing you to more risk than you're comfortable with. By rebalancing, you can bring your portfolio back in line with your original strategy, ensuring you're not overexposed to any single asset class. Another powerful tool for long-term success is investing in index funds. Instead of trying to pick individual stocks, Index funds allow you to invest in a broad market index like the S&P 500. These funds are low cost and offer instant diversification, making them a smart choice for many investors. Historically, index funds have consistently outperformed actively managed funds due to their low fees and broad market exposure. For many investors, adding index funds to their portfolio can improve overall performance without the need for constant monitoring or market timing. Let's recap the key steps to building a winning investment portfolio. First, start with a solid asset allocation that matches your risk tolerance and financial goals. Diversify across different asset classes, industries, and regions to manage risk and smooth out returns. Remember to rebalance your portfolio periodically to maintain your desired allocation and reduce overexposure to any single asset class. Finally, consider the power of index funds as a cost-effective and reliable way to achieve long-term growth. By focusing on these strategies, you'll be well on your way to creating a portfolio that sets you up for success, no matter where the market goes. Now it's your turn. What are your thoughts on building a winning investment portfolio? Have you tried any of the strategies we discussed today? Share your experiences in the comments below. And don't forget to check out our other videos on financial literacy and investment tips to keep growing your knowledge. Be sure to subscribe and hit the notification bell so you never miss an update.